As the first half comes to a close, the S&P 500 is on a tear. It's up about 15% on the year already, driven largely by big tech and AI. Our next guest thinks this bull market still has room to run. For more, we're bringing in Ed Clissold, Chief U.S. Strategist at Ned Davis Research. Ed, it's good to see you. So it sounds like what you're saying, Ed, here is, listen, if the economy's decent and earnings are decent, let's not overthink it, that the good times can continue.
Yeah, that's a great summary. Let's not get too caught up in the minutia. Earnings growth is going to be pretty solid this year. We're getting quarter-on-quarter acceleration in growth. There's probably going to be some downside revisions just because second half estimates are a little bit rosy, but overall good earnings growth. And while the economy is slowing, the chances of a recession over the near term are pretty low, and that's a recipe for the Fed to likely be able to cut probably once in the second half of the year. And so a slow easing cycle, decent earnings growth, and moderate and falling inflation, that's a pretty good backdrop.
You know, Ed, you might have seen JP Morgan's Marco Kalanovich came out with a note today and said he thinks the S&P 500 is going to fall to 4,200 by year's end. Among other things, he thinks that the market is pricing in too optimistic an outlook for a broadening of earnings growth beyond tech mega cap. What do you think of that scenario?
Well, I think a 4,200 price target implies a recession's coming. You normally don't get that kind of a decline unless you're going into a recession. So it's not just hey, earnings growth may not be as good as we think. That's really saying that there's some really bad news coming down the pike. That's not really what we think is probably going to happen. Now, I mentioned earlier, earnings expectations second half probably a little bit too rosy. Consensus estimates about 20% for Q3 and Q4 versus the previous year. It's probably more like high single digits to low double digits. So there'll be some downward revisions. But I think if you want to talk about risks, probably the bigger risk is that after such a good first half of the year, a lot of people are in the market. So a little bit of bad news could cause a pullback, but we'd be looking for a pullback to maybe a small correction, not necessarily a bear market.
And Ed, another, we're talking about variables for investors to consider. Another one I want your take on is just valuation. When you look at where we're at right now with the market, Ed, how does valuation look to you? Does attractive, extended? How would you characterize it?
Yeah, stocks are a little bit stretched. If you were to look at the trailing PE for the S&P 500, it's above its long-term average. Not hugely so. Like to say if it's more than 2 standard deviations, that's like the top 5%. Of observations, that's when it becomes like a real front burner issue. Usually it's when earnings growth rolls over, that's when these kind of moderately elevated valuations become a bigger issue. I think where I'm more focused for the second half of the year is relative valuations, that is stocks versus bonds. We've entered a regime where if bond yields spike, then we saw that, for example, last year, 10-year got up to 5%, and we got a 10% decline in the S&P 500 pretty quickly. I think that's the bigger risk. Not our base case, but if, let's say, inflation does remain sticky and you get inflation expectations getting out of hand and interest rates start to rise again, that's when investors may say, hey, I'm getting better deal in the bond market, so let's focus there. So that's, I think, where the valuation risks are.
What do you think is going to propel stocks higher in the second half of the year? Is it going to continue to be tech mega caps? Is it going to be other areas that are going to start to play more catch up?
Yeah, so as of right now, we're overweight tech and we're overweight growth. So that's kind of more of the same. And more broadly, if you're getting a modest slowdown in economic growth, the stocks that tend to do well are growth stocks because they don't need the economy to do very well to grow their earnings. They're not like an industrial company or materials or energy that are really levered to the economy. So that's where we are at the moment. Now, I think if we do get into a little bit of a pullback or even closer to correction territory, then you want to get defensive. That's where utilities, staples, healthcare and telecom, those tend to do best. Again, that's not where we are at the moment, but if people are thinking along those terms, maybe now's the time to do a little bit of research to see which sectors and which stocks you want to focus on.
Ed, I can't let you get out of here talking about politics. You had that big debate last night, Ed, I'm just curious, how are you thinking about this election, just as a market strategist? How are you thinking through it?
Yeah, so the way I think about it is Election year rallies often start when it becomes clear who the winner is going to be. Like in 1996, very clear Clinton was going to get reelected. You had two very small pullbacks first half of the year, and the market ripped higher the second half. '04, different situation. Bush, Kerry, very close. It wasn't until election night that it became clear Bush was going to win. And then after that, the market ripped higher the last couple months of the year. So we were thinking this is going to be a very close election. Probably, still is. But if momentum starts to move towards Trump's direction because of Biden's performance, maybe that election year rally starts a little bit earlier. Of course, had a good start to the year, second best first half of election year since 1928. So we've already priced in some good news, but maybe some of that general election uncertainty dissipates if it becomes clear who the winner is going to be.
We shall see. I'm not holding my breath, Ed. Thanks a lot. Appreciate it.